This is Jim Lee with Strategic Foresight Investments, and I'm going to share with you today a few market insights for the first half of 2015. Right now it's cold and wintry here in Wilmington, Delaware. We're going to talk about trends, what worked last year and what didn't, plus a few new opportunities to look at over the course of the next 6 to 18 months. This video will be best viewed on your laptop or tablet in full screen mode. Stock prices have been in an upward trend for about 5 years now. Any pullbacks that we've seen have provided for some useful entry points. That being said, many stocks do appear to be slightly overpriced, so we may see a bit more volatility this year. But there are still some good things happening. We're now entering into the strongest phase of the presidential election cycle. Seasonality for stocks is positive through the end of spring, and globally, U.S. blue chips remain one of the more attractive places for investment. So after going more than half a decade without a bear market, we are overdue, but I'm not really expecting any trouble until maybe the second half of this year, so we'll just see what happens there. The Federal Reserve has been generally successful at balancing low unemployment with low inflation, and they've publicly defined their policy goals of 5.5% unemployment with 2% inflation as measured by personal consumption expenditures. And you can see that we're now well within the sweet spot for both of these. Also, if you look at the chart with the blue line, you can see how we've migrated from 10% unemployment in 2010 to about 5.8% unemployment now. Hours in the manufacturing work week have also risen over the past few years, and everyone seems to be working hard. So there's not a lot of slack in the system, and this seems to say something about businesses running lean right now. The U.S. GDP grew at an annualized rate of 5%, which has been the fastest quarter for the recovery so far. And we seem to have one of the stronger economies in the Western world, although if you look to the right, many countries are having issues with managing their debt, so clearly we're not alone here. As a result, U.S. stocks were among the best performing assets globally last year, with the S&P 500 returning a bit over 13%. And any attempt to diversify and reduce risk through the use of bonds, commodities, or international stocks generally created a drag on returns. So a very basic strategy of indexing large cap stocks was actually very hard to beat last year. The S&P 500 is the second bar from the far left, and to the left of that is the Shanghai Composite Index, which opened up to foreign investors for the first time last year. And in my opinion, this kind of made it a bit of a one-shot wonder. As we work towards the middle of the chart, you can see that many bonds had modestly positive returns. Gold was flat, and going to the right, commodities and emerging markets were hit hard. So there were a lot of interesting ways to not make money last year. This is a heat map of the market, and the way to read this is green is good and red is bad, and each block represents a single company in the S&P 500. Big blocks represent big companies. As you can see, the areas that have been most consistently green were in the utilities, healthcare, and to a certain degree technology sectors. Energy stocks and basic materials have been a bit more problematic. So we're going to do a bit of a Goldilocks thing here and look at what's too hot, what's too cold, or what's just right. And in this case, what trends are sort of fading away, what trends are a little bit too early, and we're also going to look at what's working now. In the too late category are asset classes that have been strong in the past but are positioned to do a little less well going forward. We are finishing up a 30-year bull market for bonds, for example, and investors will insist on higher yields to compensate for higher perceived default risks, especially from the energy sector, which comprises about 15% of high yield bonds outstanding. So in client accounts, I've been shifting towards higher credit quality bond issues and bond funds. Investors have also been stretching for income in utility stocks, which now yield right around 3.2% on average and are trading at a slight valuation multiple premium to the S&P 500. This almost never happens, but oddly enough, it still makes them a little bit more attractive than long-term government bonds. Some home building stocks have also done quite well, but they tend to be a little bit more sensitive to interest rates, so I may be closing out of some of these positions by spring. It's also worth mentioning that last year we saw the most hedge fund closures since 2009, including some fairly high-profile names. According to the Hedge Fund Research Institute, the average U.S. equity hedge fund gained about 1.4% for 2014. In a prolonged period of below-market returns combined with high fee structures suggests that the boom in hedge funds is pretty much over. Now let's talk about what is too early. For example, it is probably too early to load up on cash. None of my bearish long-term indicators have triggered yet, and this trend is still our friend. Also, I don't know if we've hit the bottom yet for petroleum stocks and energy stocks. Overproduction is still problematic. The U.S. is leading the world now in both oil and natural gas production, and this has contributed to the 40% drop in oil prices during the second half of the year. Nonetheless, there are some pretty amazing dividends that are still being paid out in this space, and if you look carefully, you can find them. The emerging markets have the youngest populations, best demographics, fastest growing consumer markets, but most of their exports are still tied to basic commodities. So we need to wait for the commodities to recover before I think we'll see a boom in the emerging markets. Finally, gold stocks may eventually come out of their coma, but I expect that there may be some better opportunities even within Canadian graphite mining companies, some of which will go into production by fall of this year. And they're positioned to benefit greatly from the shift towards rechargeable batteries for both electric and hybrid vehicles. So it's kind of an emerging trend, a little bit too early, but again, I think there are some interesting opportunities here. So these are the trends that are working right now, including U.S. blue chip stocks for a reason that we've mentioned earlier. Transportation stocks are doing quite well due to lower energy costs, especially the airlines. But I've been a bit hesitant to invest in this area because it's very cyclical and prone towards labor issues. Meanwhile, consumer sentiment has risen to its best levels in over 5 years, and this reflects the decline in gas prices with improved employment conditions. Now, I do a lot of screening, quantitative screening here at StratFI, and when I'm running my screens now, I keep getting a lot of property casualty companies that are showing up for a combination of value, safety, and timing. Companies like Travelers and HCI Group, which pay attractive dividends, and some of them are trading at less than 10 times forward earnings at this point, so pretty steep discount to the market. But the biggest trend that you'll hear about this year is the Internet of Things, which may become so prominent as to be virtually unavoidable. Currently we have 5 billion people connected to the internet in some way, shape, or form, and within the next 5 years there may be 50 billion objects on the internet as well. And this means that we may soon be entering into a time when nothing remains lost, stolen, or broken. So I consider Qualcomm as a very foundational play on the Internet of Things, and also Google through its cloud platform and its recent acquisition of Nest Labs. We're also going to see some interesting things happen for wearable devices and touchless payment systems by the end of this year as well. So in summary, I think many stocks may be slightly overpriced, but are still comparably attractive within the context of a low inflation, low interest rate environment. The key here will be to watch what happens in the bond markets, and any trouble that happens here may eventually work its way to stocks. So bonds are almost an early warning system that we can look at. Finally, we are going to see an eventual recovery in commodity prices, which may signal the time to increase exposure to that area, some of which will provide the most interesting opportunities for growth over the coming years. Thanks again for tuning into our investment perspectives for the first half of 2015. If you find this interesting, please feel free to follow us on Twitter, Google+, connect with me online at LinkedIn and your website at StratFI.com, where you can see our blog and sign up for our free monthly newsletter, The Forward View.